All right, then we're gonna get this started. It is going to be usual 45 minutes or so webinar, depending on questions and how long we get on with some of the points that we need to make. I am really excited, and I know that it's a pretty meaningful day today, being Anzac Day. So first of all, I want to take a little bit of time to just make sure that we do the right thing and think about those people that gave up their lives, and just so that we can have the freedom that we have now. Even if we don't have much freedom at the moment, we have that option to keep it or not, and that is a big deal. So let's take just that little bit of a moment now to think of those people that made the ultimate sacrifice for all of us. Pretty meaningful day, especially because as Australians and New Zealanders, we are one, the way that I say it, as a community, basically as a country, even if we have our differences, especially on rugby, which again, no one else cares but New Zealand or Australia anyways, when it comes to to it. So it is really cool that we are able to do this webinar today and talk about New Zealand and Australia investing opportunities, and especially this is going to be focused on Australia. So the whole thing, I wanted to have one of the best experts in the Australian market to let you know what he's doing, what he sees in the market at the moment. He's still trading, he's still doing deals in Australia, he's still making it work because he has been through a shit lot of ups and downs. He has actually done everything that he needed to do and doing it in an efficient and proficient way. So Ben is going to be able to share with you his insights about the Australian market, and I'm going to be listening, learning from a guy that I completely respect, not just as a person, but as a fantastic investor. After he finishes talking, which he does love to talk, so especially about himself, and he's going to talk a little bit about himself, just for the people that don't know who he is, I will make a few points about what is happening in the New Zealand market, because there's been a few changes over the last week. I had a really great webinar, actually, with a few hundred people last Saturday, and I talked a little bit about my insights and my thoughts about what's happening in the market in New Zealand. There's been a few changes, or a few improvements, actually, I would call them, after that. And I wanted to briefly discuss them at the end of this webinar, so that you guys keep updated on what's new and what you can potentially start looking for. So without any further ado, what I want to do is welcome Ben Doyle, who's going to be hosting this event. And I'm going to let him speak about himself. By the way, actually, before I do that, if you don't follow this guy on Instagram and Facebook, you are an absolute idiot. This guy likes to post about his life. That's a real life of someone that's successful on property investing. Someone that's been doing it for a long time. I mean, don't let his youthful looks make you think that he just started doing this. You see, I'm
a very good point, David.
I'm saying a nice thing about you. I don't usually do those.
I know, this is unusual. What's happening?
So he's been doing it for a very long time, and he shares his lifestyle, which is, I think, more important than anything else, and his thoughts. So if you don't follow Ben, make sure that you do. It's Ben Doyle Official. You know where I am at Lazy Investor Club, so make sure that you do, and you can see all my controversial thoughts and ideas. So Ben, get started, my friend.
Okay. Welcome, everybody, and good morning, wherever, I guess, New Zealand, between New Zealand and Australia. It's almost lunchtime there for NZ, I believe. What I wanted to do was, for people that may not have heard or met me before, just give you a little bit of a brief background. Sydney born and bred, down here in beautiful Sydney, Australia. And it was in 2001 that I first started developing. 1999, my life changed. I went through a series of massive growth and mentored. And in 2001, I did my first development. Now that's some 19 years ago. Don't let the grey beard fool you. I still am quite young at heart, although a little bit older. But what I've learned in the last 19 years is absolutely profound in developing in property. And, you know, I started off in refurb. So I started off in just adding value to simple assets. Now that simple asset ended up being a block of 32 in Bellevue Hill, which was my first project. And whilst it was a large building, it was still the basic process of adding value through renovation, through refurb, and increasing the value of the underlying asset. Now, from that, I then transitioned over time into development. Now, importantly, that transition in time was with experience gained, and it wasn't just building experience or being able to quantify renovation works. It was experience and understanding and knowledge industry and understanding how to work with capital, how to work with capital partners, a few of those major components. And still to this day, the greatest lesson that I've ever learned and been taught by my mentor was how to raise capital. It's an absolute must in any property development and any property game, because you're essentially buying large assets for large amounts of money, whether it be 100,000, whether it be 150, 50, 300,000, 30 million. It requires capital. And to utilize that capital, you need to be able to structure correctly. You need to have great relationships. You need to build a great profile of who you are. You need to be able to deal with banks. You need to be able to deal with institutional money and private money. And then understanding leverage. Now, and these are some of the key components and lessons that I've been taught over the last 19 years. And I still go back to the foundations of what I was taught back in 1999. And it comes back with leverage. It comes back with being able to raise capital, and it comes back to being able to add value. So over the last 19 years, I've developed over actually now in excess of $500 million in residential real estate, between residential and commercial actually. Built over 600 apartments, between apartments and homes. And that's focused on smaller projects. So that's why there's 60 plus buildings, apartment buildings that I've actually completed. And that's for a couple of reasons. One is to have diversification rather than building towers, tower 2 or 3 or 400 apartments. I don't like that risk profile. Some people are very successful at it, and some people lose everything overnight at it. So I like the risk profile of smaller assets in multiple places. And smaller, I mean, you know, luxury could be 3, it could be 10, it could be 30. So diversification and having multiple assets and lower the risk for me is where I've really spent most of my time in development. And now more so, we've also started to branch over into light industrial and commercial, and I'll talk a little bit about that again. But now where I see the early market indicators of what's going on in our marketplace here in Oz. David, if you could just slide. Oh, actually, sorry, I didn't even show you some of the projects. So these are some of my projects that I've been doing over the last 19 years. This is one down in Northbridge in Sydney, down on Eastern Valley Way. Fantastic site. And it's always, and I know David talks about it, I talk about it a lot, about the importance of relationships. Relationships are absolutely essential in property. I don't care who you are, what industry you're in, what location you're in. Relationships and building rapport and relationships with people is absolutely essential. And this project come about through building rapport on a completely different project. So that was a great site down there in Bellevue Hill. It was 2,500 square meters, in Eastern Valley Way, Northbridge, that we put together, over 2,500 square meters. The next one I'll show you is, David. Yeah. This is our current project down in Neutral Bay. These are 10 luxury high-end residences. And when I say high-end, beautiful, exquisite finishes. We had 2 different architects working on this project. And one was all interiors, multi-award winning designers and architects, Alexander & Co. in Sydney here we utilised for the interiors on this project. PBD architects for all the external. And what you can't see there on the right-hand side, which is a grassed looking area, that is a car lift that rises up and rises back down and drops the car parking underneath the building. This is really cutting edge. It's a gorgeous site and location down in Neutral Bay with views back to the Opera House and Sydney Harbour. And if you transition to one more slide there, David, you'll see this is one of my joys is Pinot Noir, beautiful red wines. And so we had this amazing space downstairs that was going to be used for storage. And I said, this is just, it's not the highest and best use of the area. there's got to be a higher and better use that we can be providing to clients. Hence, this is the Harriet Club downstairs. It's designated for 10 individual wine racking systems in there. They have the individual caging system in there. It's the Harriet Club. They can book it out. Clients can have it for dinner parties. There's a private, behind what you can't see on the other end of this room is a private kitchenette behind the wall, which allows for staff to be able to facilitate and have a proper dinner party or a wine tasting evening. And we've got that sitting through an app system where people can book it and forward plan it and have it locked away. Now this is, and I think there's one more there, which is a project down, this is Sea Clovelly down on Clovelly Beach. We won the New South Wales UDIA Best Infill Suburban Development in Sydney. We just recently won that probably about 3 months ago. And it was due to be announced in the Australia-wide UDIA award, which was actually postponed. The awards were postponed 3 weeks ago. That happens in about a week or two's time. They're going to do that via over the net, which is going to be interesting. So that's up for the Australian award. And my amazing wife and also business partner is up for the UDIA Most Influential Women in Property Development Business. She's also up for that award coming up soon as well. So, but what it does transition me into is how to work through these markets. So, you know, I've got 19 years of experience to be able to deal with a lot of the ups and downs of development, and they come and go and they change rapidly. There's new challenges to deal with every day. There's some days that are amazing, some days that are really difficult and challenging to deal with. And understanding what's going on in the market and looking at early indicators is also an area that you've got to focus on, spend some time on, because you want to pre-see what might be happening or what may be coming around the corner. So now it's been four weeks since the government shutdown on all sort of non-essential services here for us, for Sydney. A little bit different for you guys over in NZ. For us, once the temporary ban was put on auctions and open inspections, our marketplace literally just stopped. Now, in saying that, we've been quite strong in other areas, and I'll run through that in a little bit in some other detail. But from a values perspective, so from an underlying property values perspective, it's just certainly showing a loss of momentum in the market. That's an absolute, and housing values and growth rates since mid-March have been showing that. And what we're seeing when this data comes through, it's been similar through from April. And as you'll see in the graph where it's gone through to, as a combined capital cities, you know, we're slipping into negative territory week on week for the first time since August last year. So we've got to look at those indicators and understand what's going on. Are we dropping off the cliff, or are we experiencing a lull, or are we experiencing a lull before a crash? And these are some of the things we've got to look at, and we've got to be bracing, we've got to be preparing ourselves, because we don't always know what's around the corner, but we've got to look at the data, we've got to look at historical data and say, these are the indicators we need to be prepped and be in a great position to what may come in front of us. Now, if you click through to the next slide, David, looking at for sale listings. So this is interesting. So in the 28 days leading up to Easter Sunday for 2020, the number of new residential listings advertised for sale across Australia was only 24,051. So it's the lowest level of listings, real estate listings, of this time of the year in many, many, many years. It was actually 27.3% below the equivalent period for last year. So that's substantial. And that's really happened so swiftly. I've never seen a market change so swiftly without a series of indicators leading up to it. It literally stopped overnight and changed, and panic hit, as we all experienced. And then how do you get through that? It's about being able to brace, hold, assess your positions and understand what's going on, not only locally, but globally, and also Australia-wide and New Zealand-wide, and be looking at the marketplace, be talking to individuals, be talking to tenants. I know some of my tenants over in NZ were going through a difficult time, and I worked with them. And thankfully, we got through some of those times with the rentals over the last month with them, and they've been great. But it's a matter of connections, relationships, looking at the market, looking at the data, and then weighing it all up and seeing what's happening. Because you can get lost in data really quickly and not do anything. And that can be one of the greatest mistakes. But you've also got to be very aware of what the data is telling you historically, what is going on, and what can we possibly foresee with the data moving forward. David, if you just click through to the next slide there. So looking at the property values, you know, the value of dwellings has been relatively resilient. It's relatively resilient compared to what we're seeing, considering we've had a market literally shut doors overnight, which is unheard of, unexperienced before. And I've been through a few cycles and I've never seen anything like this. Is it likely that the values will have a downturn and we'll still see some dropping? I believe so. Where is that dropping? Is it a 20%? Is it 30%? Is it 10%? Is it 5%? This is the unknown right now. So this is about being prepped, being aware, and watching what market you're in, watching how exposed you are in your market right now. You know, there's a decline, and what sort of momentum is going to pick up in this, and to what level are we going to see this? And one of the factors that we've got to look at is the amount of listings that have been put onto the market. So is the factor that we're being quite resilient so far, is that a factor of that we haven't had a lot of new listings go on? So our housing supply is being constrained because people haven't been listing their properties. You know, the pause on mortgage repayments, that's definitely had an impact in the market. It's almost it's a real impact, but it's almost been paused because people haven't had to make their mortgage repayments, and if tenants haven't been paying their rent, people haven't been paying their mortgages. But then what happens in 6 months' time? That's when we're going to see something completely different in the marketplace. We're going to see opportunities, and we're also going to see some downturn, and how we work through that is going to be the most interesting factor that we're going to look for. Domain data was showing that there was a significant increase in homeowners dropping their asking prices on their properties. So in Sydney, we had a 14% in March. So a 14% drop in the price that vendors were listing on their property pricing. So 14% drop. Melbourne, we had around 12.6% in Melbourne. And you know, other states had similar ranges. So we've got to look at this data. Now with rental yields, this is very interesting in rental yields. Now, you know, rental yields in Sydney remain largely unchanged at a massive yield of 3.7% across Sydney, which, as we know, is a horrible rental yield. Hobart's 5%, Darwin was at 5.8% over in Darwin. And your regional markets were about 4.9%. And they're offering the highest return for investors, which, you know, 4.9%, which is, you know, it's terrible. When you look and you compare that to NZ investing, you look at, you know, we wouldn't look at something at a 4.9% rental yield. You wouldn't go near it. So Adelaide and Canberra are pretty much the only capital cities and markets which recorded slightly higher yields over the March quarter, which is quite interesting, and that's been assessed over the last three periods prior. You know, so when we look back to commercial yields and retail yields, our commercial yields and retail yields here are in real trouble. Our office supply has been there's quite a good office supply of offices, but the commercial rental yields on those, we don't know where that's going to end up right now, because are we going to see a real shift of people going out of offices back to residential or smaller offices, smaller micro offices? And I'll talk a little bit more about that as well. Retail is probably the worst space you could possibly be in right now. What you're seeing is a massive closure of stores. You're seeing in the shopping centers, and I know a few different developers that have got small shopping centers where they might have 12 or 15 or 20 shops in there. And so forth. And then you've got the big Westfields, and they don't want tenants to move out because they're not paying rent. They can't pay rent, and because the stores are closed, but they also don't want tenants to be vacating those premises, because when we start to reopen back up in the next couple of months, what the worst thing is in shopping centers is they have empty stores everywhere. So the landlords are giving sort of zero rent-free periods just to see retail shops back up and running as soon as we can. But I think what we're going to see is at least a 30% decrease in retail rental yields once they stabilize. And that's only once they stabilize. This could take 6 months, it could take 12 months to actually stabilize. We don't know the output of what's going to happen there at this stage. And it's a little bit worrying. With the emerging of online sales, more and more retailers going to get away from retail and be online selling. And how is that an opportunity for the future, which is quite interesting. So that leads me over to the next slide, which is all about opportunity. You know, a recent survey, which was a social research survey. And so what they found that so socially, as in a social impact on homes. And what they found that nearly 4 in 5 Australians that were interviewed, 78% of Australians working from home, think that this will become the new normal for them. Now think about that. So that of the Australians that were surveyed, over 4 in 5 people, so 78% of Australians thought and think that working from home is going to become the new normal. So for me, I hear that, I hear opportunity. Okay, now where can you lead that into an opportunity? So another poll that was conducted in March, between March 19 to 23, found that 76% of people would stay in their employment, with their current employer, would stay in employment with the same employer longer if they had more flexible working hours or more flexibility to work from home as well, rather than having to go to the office every day or 5 days a week. So when you start to see this data, you start to look at a pattern and you say, okay, is there a upside to this? Is there a benefit that we could be working towards, or that we could see as an opportunity and create that opportunity for ourselves? And yes, I see the opportunity there. So what they also said was 57% of people that were interviewed also said that there was a lack of appropriate space, or they found challenges of working at home. So i.e., running a Zoom call with, might be kids running behind them, or it might be the noise of internal, it might be, people talking in the background. I decided to come into the office today to run the webinar from my office rather than home, just so I didn't have some of those distractions. So I do know what it's like. The distractions are great, but then again, if you're trying to run a business, sometimes they can be a little bit difficult on a daily basis. So if 57% of people saying they're finding it difficult to find quiet space to work in, 78% of people saying that they would stay with the same job and stay longer, and that they believe they would also become the normal of working at home. So for me, I look at that and I say, okay, here's some opportunity. So let me just spitball this. Could there be an opportunity for rental properties in New Zealand or in Australia? I mean, you'll be going to New Zealand for the yield, but could there be an opportunity in New Zealand in structuring rental properties that would appeal to people that could work from home? Could that be a matter of creating smaller office spaces where you're carving up into a smaller office area, which is designated, rather than taking away a bedroom, but you're creating a split room, which could be an office room? Could you be creating backdrops in those rooms, either a home version of a green screen, or a wallpapered wall, or a different colored wall that could appeal to then being able to have your Zoom calls, or have photographs and nice paintings in the background behind you, so you've got a better backdrop. It's about looking forward and thinking, how can there be an opportunity out of what's going on right now? Because there's going to be many opportunities coming up. And so, how and what markets are working really well. For us in Australia at the moment, and as you'll see from the slide there, it's an explosion of online sales, deliveries. So deliveries for online sales surged 40%. Now, a lot of those stores are now operating from their smaller locations, light industrial locations or light commercial locations. You're starting to see some of the big players like Sentinel Property Group adding to their portfolio, which is big, large, light industrial locations. We recently purchased one ourselves up in the Central Coast, probably about 5-6 months ago now, 165,000 square meters. We didn't know this was coming, but we knew there was a push to more online sales and more structured locations for smaller micro stores to be running their locations for deliveries, and in areas and precincts where they could get onto freeway transportation train lines. Staff could come in there and find easy access to these locations rather than hidden away, which light industrial parks always used to be quite difficult to get to. Now they need to be more centrally located to train lines, transportation hubs, things that workers can get to at a much easier pace. So these are some of the opportunities that I see that are coming out into the marketplace. Now, one of the flip sides to those type of opportunities in commercial and light industrial, for example, if you get it wrong, vacancies can absolutely destroy you. Absolutely destroy you, because you can have long-term vacancies. Retail, I would not be going anywhere near, but light industrial, but again, you've got a higher, you have a lower LVR, a higher deposit requirement to go into light industrial and commercial, lower construction rates, but you've got a higher LVR deposit requirement. So you've got to put more money in, lower LVR for the banks, 45 to 50% LVRs. Now, subdivisions of large spaces into micro spaces. So light industrial, commercial, and being able to subdivide those up into smaller spaces all around are much, there's a lot of benefit in being able to do that. And I see that there'll be, it's not a co-working space as such. It's more of a micro created light industrial or commercial space so people can run their operations out of there. Now, the big thing now, and what I see people should be doing, and you should be prepping and planning for the next wave. And what I mean by that is having finances in order, having all your accounting in order, speak to your accountant, speak to your finance broker, have all this work done now in preparation for the next wave that's going to come through, the next wave of opportunity. And I had a beautiful analogy of this, which I was surfing with my daughter on Wednesday this week. And she was struggling to get onto some of the waves. And, I was trying to talk to her and trying to teach her, and she was getting a little bit flustered about it. And I said, just hang on, let me just talk to you about it for one sec. The longer you wait to get onto the wave, the greater chance you have you'll wipe out when you get on. The earlier you get on the wave, the greater the chance to be able to ride the wave long and all the way right into the shore. So let me repeat that. The longer you wait to get onto the wave, the greater the chance you have of being wiped out. So if you get a wave when you're surfing out and you get onto a wave late, the board will flip up and you'll nosedive into the water and you'll tumble through. The quicker you're able to get on the wave, you're anticipating, you're looking, you're waiting, you paddle, you jump onto the wave and you pop straight up. The quicker you're able to do that, the quicker you'll be able to ride that wave all the way right through. And this works the same for investing. The quicker you're able to identify opportunities, make sure you've looked at all your possible opportunities of exit plans on it. You've got your finance in place, you've got your accounting in place, you're able to jump on opportunities, the quicker you'll be able to get onto the wave and ride the wave in. Now is the time to be being ready and prepared to pounce while others are pussing and waiting around. Now is the time. So you need to have all your house in order and be in preparation mode, ready to pounce on some of these opportunities and create the opportunities in the right spaces. So that's right, a bit of an overview of what's going on for our market and where I see opportunities.
Cool, man. Can I actually ask you a few questions now to just put you on the spot, as I like to do? That's actually based on some of the questions that I got on the chat room that I'd rather actually have you answering rather than me.
Yes.
One of them is, what market research tools are you currently using to basically make all your decisions and look and evaluate markets?
I'm looking at CoreLogic. CoreLogic analyzes data. I'm talking to valuers, valuation firms. I'm talking to quantity surveyors. So the quantity surveyors they work closely with the banks. As in, the banks will employ a quantity surveyor to handle drawdowns on your projects, so payment drawdowns. The quantity surveyor is looking at a building saying you've done X percentage of work, so therefore you could be able to draw down on X percent of dollars. So they're working in closely between the builder or developer, the quantity surveyor, the bank, and also the valuers. So between those networks, you're finding out what's going on in the marketplace. Already we're hearing the banks pressuring the valuers to be dropping rates, regardless of what they're seeing in the market, regardless of the lack of property sold, which has in effect not dropped the market at the moment. So even though the values haven't dropped dramatically, the valuers are being pressured to lower the valuations that they're doing. Now, interestingly, what we're also seeing in the market at the moment is the banks haven't been foreclosing on a lot of people. There's not a lot of foreclosures going on in the market, and therefore the valuers haven't been doing a lot of foreclosure valuations. They've just been doing a lot of revaluations for people wanting to access capital and a lot of development work as well. So CoreLogic, I'm looking at domain data. I want to see what's going on with realestate.com. I want to see some of the analysts, what they're talking about. I want to hear from the bank analysts, look at what they're talking about, and just a general feel of talking to agents. You can get lost in data really quickly. You could spend weeks in data. I've had a rule for the last 20 years. I don't watch the news, because if I watched the news, I would never have developed. I'll look at Australian Financial Review, so the AFR. I'll get my information from there that I need to, and I'll make assumptions based on talking to clients, talking to agents, talking to valuers, talking to vendors, and so forth around the market.
All right, 2 more questions that I think are pretty freaking important. One of them, I actually, I don't know if you listened to my amazing webinar last Saturday, but I did make a call as to how long I believe that this down market was going to be, roughly what I felt was going to come down to in terms of the drop. Do you have any specific ideas, any crystal ball gazing that you can do? And you would, because we actually have a couple of questions. When should I sell one of my properties? Should I actually sell now? Should I wait a little bit longer? What are your thoughts when it comes to, and I know that it's hard and I hate putting you on the spot, but not really, because it's funny in your face. Yes.
My view on selling property is that never sell unless you have to sell. If you've bought well, and you've bought it with value, so you've bought it with equity, you've bought it below market value, or you've bought your own principal place of residence, you've bought well, you've been in there for a few years. At the moment, interest rates are never been lower. It is the most ridiculous price to get money at the moment. If you can get money, now is the time to get it. But you need to be investing it really well, really safely, and really smart, because you want to be able to capitalize on when the market does grow back up. Now, are we going to see the next 6 months of a depressed market, the next 12 months, 2 years? I mean, that's crystal ball gazing. I can't do that. I think what we're going to see is a little bit of pain coming up in the next few months for people that may have lost their jobs over the last month. So we're going to see opportunities to be able to help people. And we're going to see a market that's going to be sympathetic to the amount of defaults that may or may not happen. I would like to say that the next 6 months are going to be real signs of what we could be facing over the next 2 years after that. I believe if we get businesses back to some sort of new version of normality in the next month to 3 months, we'll get out of this quicker than if we're still in the same position in 6 months' time in a lockdown. If we can slowly release everybody back out to a new normal and get businesses back selling, people back employed, I think we should be able to shorten the time period of what we're going to experience leading forward.
Okay, and then the last question for you is got to do with finance, really, and it's got a double kind of question within. One of them, actually, it's a comment that I've just read now, saying that valuers have been instructed to value properties lower or conservatively in Australia. How long are we expecting to see that, if we are? And then secondly, what challenges are you facing at the moment on getting finance for your developments? Basically more into a development kind of proposition, and how are you overcoming it? And because I've talked to you on a regular basis, I know that you are actually doing all kinds of different stuff to be able to get more developments on the way on this time of opportunity. So yes, those 2 questions, please.
First question. So in relation to valuers, how long are they going to be pressured to lower the valuation rates? I think we're going to see that until the banks are starting to feel a bit more comfortable and once we see economically things start to balance a little bit. This could be 3 months, could be 6 months, it could be 9 months. It's really unknown. If you were going through a valuation process, now is the time to do the amount of research that you should do on every valuation, which is going through that full valuation checklist that we have, where you're putting all the comparables together, because you're going to need to prove to the valuer why he should actually be doing his job, rather than just listening to the pressure that he's feeling from external forces, i.e. the banks asking them to lower the values, because the banks are asking them to lower the values so they can build in a buffer if the market does drop. They do this all the time. Whenever there's a little bit of uncertainty in the markets, the valuers straight away, they get to feel the pressure, because the banks are the ones employing them to do most of their work. So I think you're going to experience this for the next 3 to 6 months. And again, if you are going to go through evaluation now, make sure you do your checklist and follow it step by step. And David should be able to make it available. If anybody wants to email back through to the office, we'll be able to give you that full checklist of what you should be doing for evaluation. As far as what we're doing for development so far with funding, it's certainly changed. About 4 weeks ago, we had a struggle with one of our projects, how and where funding basically dried up. It changed dramatically. We had to pivot. We had to think of different strategies on how to do it. We had to offer more than we'd ever offered on a particular project, i.e. offering more in profit returns, more in interest rates, and just being smarter in the way that we created the opportunity for people. So, normally we would be the lion's share of the profit in a project. We had to flip it, and we become an equal share partner with other funders coming into the project. In saying that, any projects that we've got currently running, we've got a couple under construction at the moment, pre-sales were met, banks are happy to build all the way right through, and that's really based on existing relationships. Having those relationships built over time, building your reputation, having the banks know who you are, constantly being in communication, not hiding from them, but being in constant communication, and always having a positive outlook. Never cease to amaze me. You can always find the doom and gloom in everything. Now, I'm not saying you put your head in the sand and forget about what's going on globally. However, you can have a positive outlook and an optimistic outlook and still be taking care of business at the same time. So it's dealing with the banks in a positive way, dealing with your funders in a positive way, and showing them and demonstrating that you've done your homework, you've got everything prepped, and you've got a response to every possible question they may or may not even approach you with. And what I've also noticed, literally in the last 4 or 5 days, some funders that basically said 3 weeks ago, we're on pause, there's nothing happening. Those people are starting to come back out and looking at the moment, because they're looking at the market saying, well, there is opportunities, okay, that we haven't seen an overnight crash. We're starting to open back up. Some businesses are getting back into the flow of things. Let's just pop our head back out and let people know that we're there. We're not lending right now, but we're coming out, and we're going to be looking at things in a little bit more enthusiasm coming up. So relationships are key right now, and key to have your funders have a great relationship with you. So I would be working on those. I hope that answered the question. Cool.
You have answered that question perfectly, mate. So that's all good. Now, just so that you know, we actually have several people that have done the mentorship, several people that have gone to Cashflow Masterclass, and we have people that haven't gone to Cashflow Masterclass. So when you make reference like checklists and everything else, you kind of, confuse people. But that's all good. It's just because they haven't actually been, some of them haven't been trained at all. So they just basically logging in, just hear a little bit about what we think and what we believe may happen next. But we make sure that those checklists are in the portal and everything else so that everyone can have access to them. So that was really good, mate. I really appreciate that. I think that you answered quite a few of the questions. If there is anything else, please feel free to ask it while I'm just giving you a little bit of a review of what's happened over the last week in New Zealand, so that you can then make better decisions as well as to how to invest over here. It shouldn't take me more than a couple of minutes. So we have gone, I already let you guys know on Saturday what the decision was going to be on literally 2 days after, because I already had that confirmation from different people. And we are now gonna be in level 3 as of Tuesday, which that's for 2 weeks, which means that we're gonna basically start opening businesses within 2 weeks time. Yes, Cashflow Masterclass will be available in New Zealand. Will be actually, as soon as we know exactly when we can do events again and what the social distancing rules are, we will be putting events together. We have actually an event already sold out in Brisbane, another one in Melbourne, and then we'll do another one over here that's also sold out in Auckland. But we will be able to put a couple of extra seats, I'm sure, unless they actually make us put the seats about 3 meters from each other. Ben is actually Ben and I usually do Cashflow Masterclass together because we have a great time together and because we bounce really well of each other's energy and bring to the table very different skill sets. So that level change is massive. Now, the biggest thing that's actually happened over the last week is the Reserve Bank of New Zealand making recommendations to scrape all the lending restrictions in New Zealand. Not just to mitigate them, but scrape them, meaning that we can actually be seeing 80 or 90% lending coming back again from banks. So the banks are going to be the ones making the choices as to what they should lend. And it gets even better than that because RBNZ has also recommended and pushed the banks to lend as aggressively as they possibly can within the rules that are dictated, meaning that they want the economy to be stimulated. There are chats as well and talks about being able to leave some international developers to put some big money into the country to just get the economy flowing again, which would be very exciting. We have some really cool stimulus packages being created at the moment, which will be announced already next week in my information there. And that is exciting. That is extremely, extremely exciting. I do believe that the LVR restrictions will not be scraped. They will be substantially mitigated to around 80% at this stage. But that's enough for us to be able to really revalue and take this to a whole new different level. And this is what I actually am very excited about at the moment, which is social housing. We're seeing a massive, massive opportunity in front of us because this lockdown is not just, in my view, and in New Zealand, it's not just the 2, 3, 6 months, whatever it is that actually takes to get back to normality, whatever that means. It's the catastrophic economic consequences of the cash flow back that we're creating, okay? And that employment and all the other, I guess, byproducts of these issues. So we're going to be seeing 2 years at least of fairly painful economic conditions down under. That means that we're going to have more people needing this kind of social housing. At the moment, we have over 15,000 people on a wait list for social housing. And we have a massive shortage of property. So what we are going to see, and what we're already seeing, is different government officials, we're talking about national and local governments, pushing investment by private investors and taking leases over those properties to be able to house some of these people on waiting lists. My view is pretty obvious. The government needs to help people that they have, I guess, disadvantaged economically by the decisions that have been made over the last month or so, and that they will keep being made. The way to do that is to pay for that kind of community or social housing. That is where the smart money is over the next, and save money over the next 12 to 24 months. We are already talking to local and national government levels so that we can get those properties going. Whether you want to invest with some of the deals that we will be doing, or just actually learn about how you can actually put some of your properties into one of those social housings, that's up to you. But we are committed to giving you that opportunity because it's a twofold, it's a win-win situation there. You're going to be able to create money while you're helping people get into proper, nice houses so that they can redo their lives, so that they can start again, start fresh, and get going from these financial difficulties that we're going to be seeing. So this is definitely what's going to be happening. And it's exciting the way that I say it within the horrible scenario that we're facing, all of us. Now, there is a question there for Ben, yes. Which is, okay, so one by Stephen, I'll actually answer it quickly. What about the quality of the tenants for social housing? Honestly, in New Zealand, the quality of tenants overall is bloody good. And that comes down from the market being small and people knowing everyone. And, you cannot get away with being an ass for too long over here because everyone will know. The new social housing tenant that we're going to see is going to be the standard person that was scraping through middle class. And unfortunately, they lost their job and now they're absolutely screwed. So for me, the quality of the tenants of those social housing opportunities, let's put it that way, is going to be much higher because they're going to be people that were genuinely working and trying to get their life to the next level. And because of this set of cats, they have been set backwards years potentially. So I do believe that it is pretty full on. And it is going to be fantastic people that we're going to see, and we can actually help them out. So the question for Ben is, how much experience did you have, or do you have, or do you need to have in building, construction, and business when you started Fiducia? How did you get started? How much did you know before you got started? Did you have a good management team? What is it? What did you know? And I know the answer for that. It's a pretty cool answer. So that's why I'm asking it for you anyways.
When I first started out in property, I had that much experience, zero. I came from a bodyguard and a bouncer, was my career. And through an introduction and a evening seminar that I went to, from that led me to spending 3 days and then into a mentorship, and my life completely changed. I didn't have any experience in property as such, as in I didn't have the background to develop. I wasn't a builder. I hadn't invested in property. I didn't own any property. I didn't have any money to invest. I got taught a basic set of principles and guidelines to follow. I stuck to those guidelines, followed them to the letter, and then just developed that. I raised capital through meeting the right people, introduced from one person to the next person to the next person. So whilst I started with zero background in property or in developing, I gained aptitude quite quickly because I was taught to, I was mentored in that. And then I was just off and running. Over the years, so Fiducia started, probably about 16 years ago now. So I was 3 years into my developing career. So I'd completed multiple different developments and then started that. And then again, it's just been one project to the next project, looking at the market, developing new ideas, changing, being ready to pivot. We pivoted to light industrial some 6 months ago, which was perfect timing. And I'm always just a step ahead, I'd like to be 3 or 4 steps ahead. And I think that just comes with a little bit more experience and having the right people around you all the time. But as long as I'm at least a step ahead, I'm quite happy in that. And it's just gaining that knowledge and always expanding on it continuously. Hope that answered the question.
Yep. No, that's awesome, mate. Cool. That's really good. So I really appreciate your time today. That's pretty good. I think everyone enjoyed it. If you have anything else you can think of, please feel free to ask for it now. 1 second. Last week, recovery phase would be anything 12 to 18 months. I'm reading as I'm actually talking. I cannot do 2 things at one time, so sorry about that.
That's true.
Okay, so we're talking about different events like the America's Cup and everything else, and how they will affect the recovery. Obviously, it's going to be a positive thing. Anything that can actually happen, it's going to be positive. Don't get me wrong. But the America's Cup in itself potentially could safeguard some of the drops that we're going to see in apartments, which I talked about on last week's event. So that is a blessing for us. Saying that, it really depends on the decisions that are being made today, how long this is going to last for. I still do think that this is going to be just as long or a little bit longer than the vacuum that GFC created. The vacuum that GFC created obviously was a money vacuum. This one is a cash flow gap vacuum, but very similar in the way that it is, or the consequences that it's going to create. So I do think still that those 12 to 18 months we're going to see that vacuum and that drop in price, and people hurting the most, people putting more properties in the market, less buyers there. So it's going to become a buyer's market. You're going to be able to negotiate better. But this is going to be, honestly, the best time to accumulate. And that's what Ben was trying to talk about, to accumulate a good size portfolio over the next decade. This is your entry point over the next 12 to 18 months. And this is the time where you have to just put everything. I was listening to Cardone, actually, Grant Cardone, a video yesterday, I believe it was, if not the day before, of just saying that the biggest mistake that he ever made was not to put more money into his education and into actually his investments early on. He was just saving money. This is the time not to save, but to actually invest as much as you can. This is when you're going to be creating wealth for the next 10 to 20 years. This is the time where we're gonna see the divide between the people that have money and the people that don't have money become even greater. This thing is gonna create a divide that's gonna make the divide that we had before look pathetic. This is the time where we can create money and do it in a social conscience, though, and that's what I want to keep telling people all the time. It's not just making money for the sake of making money. It's making money with a heart, making money so that we can help people. Because we will all have more than enough to be able to do extremely well through this. Hopefully that answers some of the questions and thoughts. I want to thank again Ben for giving up his time and being here. It's always bloody amazing to be with you, brother. So thank you very much once again, and I hope to see you guys very soon. Thank you, Ben.
Thank you all.